In mid-January, the 10-year stood at 4.8%. Here to break down where rates go from here, Andy Constan, who's CEO and Chief Investment Officer at Damp Spring Advisors. Andy, great to see you. Thanks for joining us tonight. How much lower do you think the 10-year could go here under this, uncertainty scenario?
Thanks, Melissa. I think that the 10-year has moved a lot, obviously, and what it is going to take. The last time I was on your show, I said what it's going to take for it to really get much lower is the actual contraction, not just the fear of contraction. But it seems like we're heading that way, and so we could easily see a funds rate at 3%, like J.P. Morgan is saying, and I would expect the 10-year to settle around 3 3/4 in that case.
Is that how you are positioning your portfolio? The assumption that there will be not just a growth scare, but that there will actually be a contraction and that we will hit a recession? I mean, what is your sort of baseline?
Yeah, I mean, that's been my baseline and that's been my positioning. But prices have changed a lot in the last, in the last 6 weeks. NASDAQ's down 22.5% from the highs. The S&P's down 17.5% from the highs. That's a big change in price. And the base case of a recession would take stocks further down, most likely. But we're getting to a point where it would have to be a deeper recession to get stocks significantly lower. So I'm fairly neutral at this stage, slightly short.
Andy, it's Tim. If I look at French or Italian, dare I say, and certainly German bunds relative to treasuries on a 3 to 6 month basis, and if I FX hedge them, there's not a great pickup to own in U.S. And if I look at European investors, why wouldn't there be a home bias? And is this something that's not a big deal? Is it a big deal? Do you see more of this happening? And ultimately, again, Treasury Secretary Bessent seems to be obsessed with getting the 10-year down. And is it too much too fast? And is it leading to some of these other dynamics, which I think are strong and are only picking up steam?
Sure. I mean, I think the first thing is the slowdown in the United States is going to be a combination of tariffs and fiscal contraction, which is what has been expected and I think still expected. But in Germany, you have this fiscal expansion, which makes the growth situation much better for Germany, which would mean that the German Bund would actually tend to rise in yield relative to the U.S. yields. But I think there's this other dynamic, which is the tariffs are going to reduce global imports. And when we import, we hand our dollars to a foreigner. And those foreigners are forced, because of the necessary place to put dollars, is into U.S. dollar assets. And they've bought treasuries, but they've also made foreign direct investment. And like never before, they've also bought U.S. public equities. Now, tariffs are designed to reduce the trade surplus, which doesn't eliminate demand by foreigners for U.S. assets, but does reduce it for what has been fairly consistent demand over the decades. And that means that our deficit and our assets will have to be absorbed by domestic savers. And if you notice, the U.S. bond market is rallying significantly. So there must be significantly strong demand, which is likely driven by the slowdown, but not driven by foreign hate selling or foreign concern about things like their taxing income for foreigners, or certainly not selective defaults. So there is demand for U.S. bonds from foreigners, but Trump is asking for more foreign direct investment, while at the same time our trade is giving foreigners less dollars. And if that foreign direct investment comes, it has to come from some money, and that's likely going to be U.S. equities.